What is investment strategy, and should you care about it? Hey there, AlphaGo here, and thank you for coming back to the channel. Today we're going to answer those two questions right now. So investment strategy or a investment strategy is your personal strategy in which you're investing your money. Simple as that. And really, you should have a strategy when you invest your money. You shouldn't just willy-nilly throw your money in. And this stock looks good. Cool. This business looks okay. Let's just buy some of that right now because I heard a hot take on Twitter. I heard a hot take on Reddit. And you know what? I want some of that company right here, right now. And I don't want to FOMO out of getting some of that company. That is not a strategy. A strategy is understanding the fundamentals of what your portfolio is doing and why you are buying companies, why you're buying stocks to add to your portfolio. So an investment strategy that I like to implement within my portfolio is a strategy of dividend growth. I like to focus on companies who have a track record of not just paying dividends out, but of growing their dividends over a year-to-year basis. Every single year, they compound the growth of their dividends. They pay anywhere from 10, 15, 20% year-over-year growth of their dividends. So what that means is I will buy some of that company and they will start paying me a dividend, potentially a 3% dividend every single year. Cool. I buy $100 worth of that company. They pay me a $3 dividend every single year. Got it. But if they have a 20% or a 10% year-over-year compounding growth of their dividend that they have a track record of, that $3 dividend becomes a $3.30 dividend the next year. Then it becomes a $3.63 dividend every single year after that. And it completely continues to compound and grow every single year because I am focusing my strategies buying dividends that have a track record of compounding and growing their dividend every single year. I don't want a company that pays a dividend every year, but it's a stagnant dividend. It just stays put. I want a company that's going to pay me a dividend every single year that ideally outpaces inflation 3 to 5 times. So a dividend that's going to grow their dividend 3 to 5 times faster than the typical and average inflation rate. The purpose for this idea for me and my dividend portfolio is the fact that when I am able to live off of my dividends, off of my portfolio, those dividends will cash flow into my account and they will grow faster than the inflation rate will. So theoretically, my buying power will always continue to actually grow every year rather than decrease every year like inflation will do to just a nest egg of static money sitting in an account somewhere. So if you put money into a savings account and the savings account gives you a 5% or a 1% growth every single year on the interest of that it gives you, if inflation is 3 to 5%, you're losing buying power every single year because inflation's outpacing your interest rate growth. But if your dividends are growing 5 to 10 to 15% every single year and inflation is 5% every year, you're getting 2 to 3 times buying power growth over the dividend. So if you actually net difference it out, you're getting 100% to 200% growth potential on your money compared to the inflation, what it's doing to it. That's what I want. I want my buying power to continue to grow because I don't want to have to worry about whether or not my dividends or worry about whether or not my portfolio is going to outlast my life of my family. Because my strategy for my dividend portfolio is that I want this to be inherited down to my children's children. I want a generational wealth building machine that I can leave to inheritance for my children's children. I want to split it out and give it to all the grandkids because hopefully at that point, my kids don't need it. My kids are set up financially and successful themselves with their own portfolio, for example, and I can help them take care of their children. Or at that point and my children are old and my grandchildren are getting old, but they are completely self-sufficient financially themselves, then my portfolio can be my great-grandchildren's inheritance. And that is what I want. That is my personal strategy, is I focus on dividend stocks that grow their dividends, and I'll take the added bonus if the companies themselves grow as well. That is my investment strategy. Along with that, I do like to diversify the companies that I do own across different sectors. I don't want all of my dividends to be in the tech sector, for example, because if the tech sector gets hit in the future, it can happen. It's happened in the past. It most likely will happen in the future. And I don't want the valuation of my entire portfolio to drop because I don't want to risk my companies going bankrupt. And if the industry completely tanks altogether and multiple companies have to file for bankruptcy and go to zero, I don't want a a large chunk of my portfolio to go to zero because most of my portfolio is in one sector and it gets hammered hard. It can happen. A few years back, about 8 years ago, back in 2016, there was a massive effect that happened in the coal industry out there, in the materials industry focused around coal specifically. If somebody's portfolio was heavily weighted in coal, 75-80% in coal, every single coal company, as far as I'm aware, correct me if I'm wrong down in the comments, filed for some form of bankruptcy. And most likely, if your portfolio was heavily weighted in those companies, you lost out hard. When those companies filed for bankruptcy, your stocks would have depreciated to zero. And then a lot of those companies reset their stocks into a different kind of company, and you did not get transferred over. So you lost your money completely. You had to start from scratch. I don't want that to happen in the future for me. I want my companies to continue to grow. I want them to be in existence. I don't want them to go to zero. I won't mind one bit if they drop stupid low. If they drop a 90% valuation, I am actually cheering because I am different. I am the contrarian investor there. I am completely different. If they have a 90% drop in valuation, I am looking at this as my stocks are 90% on discount. I like the idea, but my portfolio is diversified enough that I am not worried that if they go to zero, if they have a 100% drop because they're gone, okay, got it. I got cash flow out of them. I got a lot of money back. I didn't lose all my money whatsoever. I reinvested those dividends into other companies, got valuation growth there. So I'm not losing completely because my portfolio is diversified around into different sectors. So when you diversify into different sectors, you're mitigating the downside potential. You're mitigating your risk. When you diversify, you're mitigating your risk overall. And an investment strategy that you should really probably focus on is mitigating your risk. It is diversifying into a wide range of different sectors so that the downside potential that you experience is mitigated and lower, because you don't want your companies to go to zero. However, you do want your companies to drop in discounted price, that you can buy more of them. When you can buy them at a discounted price, you can get more shares that pay you more dividends overall. Because if you buy solid companies, those companies will rebound and they will come back up and they will continue to grow their dividends and you will continue to reap the benefits. I would rather buy 2 shares of a company than 1 share of a company that's going to pay me dividends, because I get double the dividend income from that purchase. And a concept to understand to bring your proper strategy together so that you can implement something effective for your timeline horizon is really, you need to understand what is total returns, because understanding total returns will help you devise and create an effective investment strategy for your timeline horizon. And I've actually done a video that's going to be right here on the screen that you can dive into it. It simplifies total returns and what it can mean for your portfolio. And I'll see you on that video.